guys. So I'm gonna start a video series where I go through different real estate investments that we could make. Um, Now most of my friends are W-2 earners, so I think we're pretty limited to the type of real estate investments that's available to us. Um, and I'll go through a series of properties that we can invest in that's available to us. So single family homes, some maybe a duplex or up to 4 units. Anything that's over 4 units is considered a commercial unit, and the loans are quite different. You have to have experience managing commercial units. You have to have experience being a property manager or investing. So for the first one, I'm just going to go through the numbers, go through um, how you would select a property, look for rent comps, and finally look at what type of rental income and profit you could make in this environment. And you'll find out pretty soon that in the current rate environment where interest rates are floating around 6 and 7%, that investing in a single family doesn't quite work out for the average earner. Uh, and I'm going to, okay, so I'm going to share my screen. Okay, so let's say we're on Redfin. We want to look at a townhouse that we want to invest in. Price range is 600 to 800K. Um, and let's just take a look at my neighborhood. So townhouse. So the good thing about townhouse is they are quite low maintenance, and you could buy pretty nice townhouses in Seattle that rent pretty well in high demand, um, or less than $1 million. So I'm just going to take a look at this one. Now this is it looks like a pretty new build. For very typical for Seattle, 2 bed, 2 bath, 1,100 square feet for 700K. Yep, this is a new construction. Now, Redfin does a pretty good job estimating your monthly payments. So we go down here, we can see that, okay, the payment calculator is about 4,000, but for some reason it did not put any property taxes. In Seattle, it's about 1%. It's going to be slightly lower than that, and we're overestimating here just to be conservative. So, a homeowner's insurance for a townhouse, you're going to be able to get for about $1,000 a year. So $1,000. So let's do that. Um, let's see, there's small HOA dues here, nothing big. Um, and if we put 20% down, initial investment in about 140K and about 7%, your monthly payment comes out to about 4,400 a month. I'm going to walk through how we would look at rent comps and what kind of rent income you can make from this property. So I go into Zillow and I look for properties for rents. 2 bed, my criteria is 2 bed plus, any bath. You can go into home types too, and right off the bat, I think they're building quite a bit of new construction townhomes here, so we're able to find that this is a pretty similar property listed for rent. 2 bed, 1.5 bath townhouse for 1,000 square feet. And they're listing it for 3,380. I think this is a bit high, but they might be listing it. I think there's only been on Zillow for 14 hours, so they're gonna list it and see if they can get lucky and get anyone in for this price. Um, so right off the bat, we see that your payments are 4,400 per month, and your rental income is 3,400 a month. So right off the bat, you're going to be putting money into this property at $1,000 a month. So, and if you self-manage and nothing goes wrong, that's about $12,000 a year that you have to put into this property um, as a rental. Now let's go into the details a little bit because there's a lot of costs associated with owning a rental property that most people don't think about. Now, spreadsheet looks a little bit intimidating, but I'll walk through it. So this is a spreadsheet I built based on your purchase price, loan terms, um, initial investment, and all the other expenses that could be associated with owning a property. So let's say we're able to buy this property for 680,000. I think the townhouse has been listed for 3 months now, might be able to make an offer for lower. Loan LTV is loan to value. So we put this is the percentage of property value that we are borrowing from the bank. So we borrow 80% of the property value from the bank. So that comes out to 544K. It's a 30-year mortgage. And let's say that you find a really good lender, and you find a 30-year fix for 6.25%. Your down payment is 20%. So your initial down payment is $136,000. There's going to be some closing costs associated with the loan, escrow, title insurance. So your initial down payment or initial investment is going to be about $151,000. Your gross rents, let's be a little bit conservative. They listed it for 3,400. And let's say we're going to only be able to get 3,300. So this column is your annual income, monthly income. This is your annual expense and annual income. Your mortgage payment, now this is a calculation of principals and interest based on a formula for the loan amount and the interest rate. Property tax, 1%. Insurance, let's do 1,200 because insurance for rental property is going to be slightly higher than your homeowner's insurance if you live in the property. Maintenance. Now, if you're buying a older property, you should budget about some dollar amount for maintenance. The general rule in the real estate market is it's about 5% of rent for an older property, but you just never know. So let's say this is a new build and there's not going to be any maintenance associated with it. So we could say we're going to estimate $0 for maintenance. Vacancy rate. Now, you need to budget for vacancy rate because every time you turn over a unit, your property might be sitting empty for 2 to 4 weeks, let's say. So 5% vacancy rate means that how many percent of the year the property is going to sit empty. Now, if we say if we calculate 365 days, 0.5%, so you're estimating that the property is going to sit empty for 18 days out of the year where you're not earning income. So we're budgeting that as our monthly and our annual. So annually, that's about $2,000 of rental income that we lose because of vacancy rates. Management. Most people don't like to self-manage their rental property. And if you manage property, that's about 8% of rent that you're going to be paying to the property management company. let's say tax return prep, let's just say that you have a CPA that will do this as part of your tax return. So I'm not going to estimate anything for that. Your total expenses monthly is about 4,400. Your income's 3,300. So your net cash flow monthly is 1,100, and every year you have to put in about 13,000, 14,000. Your cash on cash return, which is your rate of return on your initial investment yearly, is a negative 9%. So you're basically losing 9% of your investment per year. Um, and let's say, well, what if we look at this on a forward-looking basis out 15 years, right? I've built some assumptions here for rent increases and other expenses that increases. But the good thing is, with a 30-year fix, your principal and interest payments do not increase. They're fixed for the life of the loan. So you're going to be enjoying some rent increases through the year, but your mortgage payment will stay fixed. Where property tax is going to increase a little bit, insurance will increase, vacancy rate will increase along with your rental income, management fee 8%, and it increases slightly because they're collecting 8% of rent. So now you can see that in year zero, you're paying 151,000, and every year after that, you are paying slightly less because your rental income is going up. So while your rate of return is increasing slightly, by year 10, you're still losing about $7,800 a month, a year on your initial investment. And if we sum up the amount that you have to pay yearly, by year 10, you will have paid $106,000 for this property. And this is why investing in a single family home in Seattle just doesn't pencil right now in this rate environment. Now, if we bring this rate down to 3%, which was the rate that we saw during COVID or before COVID, these numbers look a lot different. You see, with a 3% interest rate, you're breaking even, which is not bad for a real estate investment because you are going to enjoy some appreciation from your property. And in 15 years, you're actually going to be cash flow positive. But this is calculated off 3% interest rate, which is not possible these days. So, I'm gonna stop sharing. That wraps up the first segment of my series. I'm gonna go through other properties. We'll go through maybe what the numbers look like for a more expensive house. Um, we can look at multifamily, um, and any other investments that you would like to see. Thanks.